Hello, welcome to Steve's Stock. Today's topic is to talk about how to use moving averages. This is lecture 1. What is a moving average? Basically, give n consecutive days and we figure out one number we call the moving average, which is defined as following. You add this price together, divide by number of the days. Give you an example. Look at this chart as Apple, September 16th and 2021. And suppose we pick one day. Here is one day. And this August 25th, 2021. And then the range before this day. Suppose we pick 20 days moving average. So we pick 20 days here. For 20 days, you have a closing price for each day. So the moving average for this particular day is defined this way. You add this price together, divided by 20 equals this 147.45. This give you this point, and this point is a moving average. So what is a moving average line? Typically, you do not see a lot of data on the screen. You see a line. So basically, you connect the moving average for each point. You get a smooth line, and this is called a moving average line. The good thing is better for view, and you do not see many dots. It's easy to plot and no confusion. What do we use for moving average? And one thing by the definition, you see tell you average people holding price. So we can easily see the price and see people is losing or gain. And we know that people gain or loss, it will impact the stock movement. And the other advantage is when you look at the moving average line, you can see stock is going up or down. Look at this chart. We have 3 lines moving average, 20, 50, 100. Here we know if a moving average is going up, the stock is going up, and moving average is moving up, the chart is above the moving average. And also you see the multiple moving averages, and short moving average is above the long moving average when the stock is going up. So if you look at the position of these moving averages, you can figure out if the stock is going up or going down. Here, why we draw multiple moving average. One advantage is short moving average is more responsive than the long moving average, and they change directions more frequently. There is a disadvantage to use that. Here, we introduce a very important concept called the EMA, Exponential Moving Average. the basically idea is adding more weight to the near days to make a moving average more responsive to the change. And you see the formula will come to this way with lambda 1, lambda 2, lambda n. These are the weights. The weights for this case is defined by power lambda to n minus I index. And this is, you see that is exponentially. So this is called exponential weight. The idea doing exponentially is because this sequence is going increase quickly if the index changes. So we give some more weight to the recent days and less weight to the faraway points. It makes it more responsive. There is a very simple way to calculate this exponentially moving average. This is kind of equivalent, but this is very simple. So you use the previous day's moving average, multiply by 1 minus k, and add the current price multiplied by k. The k is a constant. It depends on the range n you're choosing. Now you can see this price has a weight on that. So this one, the overall is not average anymore. It does not represent every people's buying price anymore. But it's more responsive. It's more quickly to tell you the changing directions. So in the trading world, many people care the direction rather than the average price. In that case, we'll use the EMA very often. We'll not tell the difference between them and from now. One thing we have to tell is when you calculate the moving average, you need a number of days. For example, for 20 days moving average, you need 20 days. But so then for the a stock, and the first 19 days, you don't really have a 20 days moving average. So that chart, this point is actually missing when you draw the chart. Now we want to say why this thing is so frustrated. If moving average can tell us the direction, we can just do as they suggest. That's kind of simple, right? Let's see one very common strategy to do that. When short moving average is above long moving average, it's going up, vice versa. Then we can use the point when two moving average changes their relative positions as our buying point. And when they change the position again, we can sell the stock. Look at this example. This is the Apple. And we see 50 EMA and 100 EMA as two lines here, blue and red. And you can see at this point the blue line cross the red line, and they cross it again here. Okay, so what you do is you buy at the 45, and you roughly sell on the 60. Well, this basically, if it's not too bad in this case because we get a profit. You can see we didn't sell at the very high range, but it's kind of missed a lot here. So let's check another example with the same as Apple, and you see the moving average line cross here and cross here. So by the rule here, the red place we should buy and the green place we should sell. And now you have you buy the 27.5 and sell as 24, which is very bad because you lost money. Well, the reason is when the moving average cross here, but the stock does not go up anymore. It's kind of a fake signal, right? So the other thing we notice here is in this case the signal is very lagging. Even the sell signal gives out and then you sell at a very low price. So it's kind of frustrating, right? But as people know, everyone know that we can prove in a lot of history data, we can see 20 EMA and 100 EMA as a pair to do the buy and sell. If you control with certain trailing stops, it is a profitable overall strategy. And it's by zero, it works. However, the statistics may not work for public traders, as we do not trade all the possible cases with all the positions. We can only pick some. And we are human. We do not operate like a machine. When it is good time to sell, you sell. Time to buy, you buy. See, by our nature, usually make us pick the wrong decisions. Since we want to get better, there's a place we start to make a change, make things better or worse. In most cases, when we make things worse before we learn how to do it right. There are the two trading strategies based on the moving average. One we call the trend trading, one called the reverse trading. Let's talk about them. When the stock begin to move in a major trend direction, it will go on rather than change direction. Some stocks move months or years in one major direction, with a minor movement against the major trend. So the trend trading the idea is follow the trend. It has been commonly believed moving average in this case is a very reliable way to tell you the trend movement. Well, the reverse trading is like we talked about earlier about the two Apple traders. We base on the moving average crossover to tell us a stock is changing that direction. First of all, for the trend trading, can we find a moving average so that the stock is moving on one side of a moving average? And let's look at some examples. See, this is CYH. The chart is most time on the one side of the 100 EMA. And if you look at the next chart, the CGEN, the chart is and this 100 EMA. And then we can look at the third example. It's the AKAM. So sometimes up, sometimes down, sometimes up, sometimes down. It's like a keep changing, not far away from the moving average. So the idea is when we go to the uptrend, we want to try and find some example like CYH. And when we do short, we want the CGEN. So we use this moving average to tell us the trend is going up and going down, and stable is in good shape. But here we are not to tell the trend is changing. We try to change has a good shape. That's why we call this method approach is a trend following. So basically, when the major trend you think is up, you buy. When it is down, you short. Now, next thing we want to talk about is any time better than the other time to buy? See, the idea is when stock is in a major uptrend, it stays above the moving average. We notice when it's close to 100 EMA, that it may bounce away immediately. See, when it got close to this 100 EMA, it bounces back up. So you here, look at this point. So here looks like this way. Here is number B here. And the C, you see C is here. And when you get close to the 100 EMA, it about to bounce. Or we can assume it will bounce back, but you will ask us why this is too much assumption, right? Yes, you're right, but you know, we are working with a probability level. If you say uptrend, they go long while, there's more chance to bounce back than the way they change the direction. So we will play by probability. Now, one advantage to buy when it's close to the major EMA is that we only needed to wait for a short distance to prove us wrong if we are wrong. That means we lost less time and or lost less money if we are wrong. See, for this example, and there's a point B there, and point C there. If you buy a B, and you have to wait to roughly point D to see, oh, this is the wrong direction, but C is close to the D, so you buy C, you have a less risk than point B. This basically this approach means the EMA line is like a major supporting line. Most time they can support these stocks going up until it does not support. See, this is a very frustrating trading when we are wrong, right? In this business, we know it's working on the probability error level. We have to develop a way to minimize our loss when we are wrong. So basically, we have to cut loss and move on. You don't want to hold this downtrend, right? So this one here, we talk about adaptive. So if possible, you want to change your direction when stock has changed the direction. You don't want to stuck with it, with the same direction when the stock gets changed. Well, here we can see we can use the 3 moving average together, and the 2 of them tell us the major trend. For example, 50 EMA and 100 EMA are aligned in good shape, and when they align in good shape, we know this the good uptrend. But the 3rd moving average, with the short one, can tell us if it's time to bounce from pullback. So basically, this a moving average, short moving average, when they change direction, and we buy that. This is kind of relatively safe. This one is a little bit lagging, because moving average always lagging. Is lagging on some other approaches like a trend line or Japanese stake approach, but it is more reliable in many cases. The trend trading basically is you have to find evidence to show the trend is conformed as moving while no direction. Then it's a time to move it in. Well, the safe point is just give you some more profit and less risk. But however, if the trend direction is right, they bring to you profit, even you access a relatively wrong point. But as long as your direction is right, major direction is right, you finally get the profit. So here, what we want to say is the trend is a friend, because you want to follow the major trend. You don't want to do against them. Now we have additional notes for the trend trading. The first one is do not miss champions. And it looks at the champions. This is the board on the September 20th, 2021. And you can see this going up from 20s to 80s. And you don't see much pullback. So you have to go with that. You don't want to wait to pullback. There's no pullback. Very nice. And the second note is when you see examples like the direction is not so clear. See, this is like in 1900 range moving all the time, and do not enter and let it do its consolidation. You after the end, it's going up or down. You don't know. Let's just wait that. See, this is called stay away. And third one notes we give an example. Say some stocks are going up very fast, and at least in the very end of few days, and it's going up faster than the other time. We call the parabolic upping. In this case, you have to be careful. You don't want to buy it on the very end area, because the pullback is very strong. And see, for this case, AMEH, they pull back easily 30% in 1 month. Now, we want to warn you is never make counter trend bet against a major trend, neither purposely or unintentionally. As one example, we are warning you as a beginners, this is SOXXS here. So you look at this chart, is those goes of like 200, 300, and 400, and going down to 50s, and you think it's low enough, but you have to think it again, because they can go down to next whole year, go down to numbers $6. So this chart, just remember this chart, this is a big warning. So here we want to tell you is never too high to buy or too low to short. And in this situation, you want to protect your position. If you, in case some reason you get in, and you have to protect, you just get out. You know you're wrong. You don't want to stay with it forever. Let's talk about the reverse trading. Reversal trading is more difficulty than the trend trading, but it brings more profit. Say if you get earlier, you know it's reversing, then you catch the low price on the ups, and if you go short, you get the high price when begin to short. See, it's kind of attractive, but it happens every day because you want to guess the trend changing. Usually, there's two ways to do that. One is using moving average to guiding you the trend is changing, and the other way is called reversal patterns. Well, the EMA crossing may indicate a good point that a major trend begin to continue its path, but it is a reversing a minor trend. This gives you higher probability to win the money, because the major trend will finally bring you profit. Even the point you get in is not so accurate, but the trend will give you profit. So, see this example, and this kind of reversing. If we talk about reversing, so we see the moving average crossing. We see trend begin to change. Well, here's the 2 points we have to make here. One is there's a lot of lagging. So the maximum point for this example is probably like 54. But if you look at the trend, the moving average changing, and you see it's probably 30s. So it's you really lost a lot. So the strategy, right strategy, is you watch out when the pricing going weak after the parabolic upping, and this area most likely is the final place you want to get off. And some people can get off from this particular second point because their second trying to get a new higher fails. This also can help you get out. But this sometimes you get out too early. But here that's why sometimes we want a reverse pattern to tell us it is reversing. We talk about this in other topics about the patterns. Here, let's talk about some patterns of the reverse trading. It's using moving average. You see, this is moving average crossing, and we trend is kind of changing. This is Apple's 2008. You see the consolidation from October to March is in the range, and finally this price cross the moving average, and from there, and it has a good run. Let's look at another example. It's NFLX. It also has this kind of bottom. This it's like a W. This usually is called the double bottom. However, we see a crossing here. Is a moving average crossing. The short one cross a long one, but it fails, right? So we need to understand how you identify these failings. We talk about the next future topic. We cover more strategies to avoid or minimize the chance to get it wrong. See, this W here is kind of very high probability chance to tell you the trend is reversing. So here, after the W, is go up from here and go up. Here, we want to show typically 1 year chart before big ups. So when you look at the patterns, looks like a chart, 1 year chart, you can see how this should look like when they going up. See, this chart is RAD. This go down from 40s to 20s and all the way, and finally it goes, you see the volume here, and it goes up here, and the EMA crossing here. And this is a trend we want to tell you. It's a strong 10 point, and this 10 here, and they have a up 530% gain after this crossover. Let's look at another example, similar example. You see this kind of on the bottom, it's doing like this, and consolidation, and up and down, and finally get up. You see the volume here, and a similar one, right? So this we want to see, we can define this kind of double bottom, and with a good volume, and the uptrend. After that, you see the big gain, and this one also has a big gain. See, in this example, we emphasize here is these can be wrong when you exit. You see the point when you get a crossing. The first time it fails, and this is a place you might have a little bit wide stop to protect you, so you don't really get out because they pull back. But in some case, if they don't turn up, they go down from here, you should get out. We give you more example here. This example is showing very severe sell. You see this sell is very severe, very severe. And then when they have some time to go up, and here adjusted consolidated this range, and it's go up and consolidate range, and then after the finally they cross over and do very good after that. We see more examples. This one is they actually has a pullback here, and then go up. Similar. So this one, we know this major trend actually is already confirmed as uptrend. So there's a pullback, and kind of reverse. But this reverse is like a short moving average reversing, but the longer major uptrend is not changing. It's confirmed already. So this one see the short change and then continue, and here they continue. We here we give 2 examples. It's they have a very long range of consolidation. It's like make a big W candle, and before they cross over, and give you a very good movement after that. This example tell you they have a kind of nicely moving and in a range for a long time. You see, long time. This is more than a year movement, right? It's happening, and finally, when the moving average crossing, finally, and it has a big short shoot from there. You see from here, go. So now, as the end of these patterns, we want to give you a warning, and I want to tell you the consolidation can be very long on the top, very long. Sometimes, for example, AMD can consolidate 18 months. You just do not want to lock your money for 18 months if you are doing trader business, not investing. So in this case, you can see very long time. So just be patient to get out, stay there holding, and see how finally go up. We want to tell the tricks how to avoid this kind of major. It's a cross point, but it's kind of it does not start the real movement. We'll have a topic cover that later. See, this example will show you it's majorly it's a downtrend, but the crossover they give so many fake signals. So you don't think the signal just once. They can give you multiple fake signals, so you can keep losing money if you don't do it right. So finally it goes up. Again, we in the other future topic will show you how you avoid these kind of situations and catch the right one on the big ups. Here we want to summarize a little bit. And first thing, when we see this consolidation, we want to see big ones. We want the trend has got prepared very well, and keep the weak hands got to check the change to strong hands, and see the trend does not change overnight. They take time to build up. See, what usually we want to earlier want to see is 1 week till the price has if if it goes on up or starts strong, that price bar is above the 20 EMA. And also we see the volume is supporting. On the up days they have bigger volume, and the down days a small volume. These two things give us higher probability, but definitely we know there are some exceptions if even these two things are aligned together, but the trend can go fake signal as well. And the other thing is we want to see every time when they change, when we're thinking the trend begins, we want to see if these holding the good shape after the movement. If they holding good shape, we know we are right. We keep adding the more to it, or keep holding. And the other thing here, what we can do is we look at a 3-moving average. If you see this 3-moving average, and they are in the line up, basically in a good shape, in the uptrend, good shape. So this will give you a confidence. You will hold it. So moving average is basically tell us identify the trend. So we do not want to do against the trend. We want to follow the trend. This will increase our probability. We always like to emphasize that the exit strategy, you have to control the risk. You have to use some guidelines because anything is possible. If you do not have a way to protect your position, you will get a big shot one day. This moving average and all these strategies we talked about here is just give you higher probability, give you better performance, but the signals can be wrong, and you have to protect. So thank you for listening to this topic, and see you next time.